Hey everyone, welcome to another episode of AdMail. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hi everyone, Adam Bergman here, tax attorney and founder IRA Financial, and welcome to another episode of AdMail. On today's AdMail, self-directed IRA basics. That is the topic, and I'm going to discuss 3 questions involving the topic of self-directed IRA basics. The first will cover the Roth IRA. The second will be about using a special IRA custodian versus using a traditional institution to set up your self-directed IRA account. And then thirdly, about rolling money into a self-directed IRA from a former employer 401k. So again, just to explain some of the adjustments in the formula for this podcast, just got a lot of feedback saying, hey, Adam, just be helpful if you kind of keep questions related to a topic at hand, just easier to learn and easier to just adapt and absorb the information on the podcast. So that's what I am going to do. Your wish is my command. So let's get started. First question from Erica. Hey, and Erica wants to know, can I do a self-directed IRA with a Roth IRA? So Erica, yeah, you can. The self-directed IRA concept simply means that you're using an IRA to do an alternative asset investment. The word self-directed IRA is not in the tax code. When IRAs were created in 1974, it did not distinguish between an IRA and a self-directed IRA. Section 408 and 4975 basically just said there are 3 categories of transactions you cannot do. 408 said life insurance and collectibles are not permitted. And then section 4975 talked about various types of prohibited transactions, which in some involve scenarios connecting an IRA and a disqualified person, which is the IRA owner, their lineal descendants, parents, children, spouse, daughter-in-law, son-in-law, or any entities controlled by such person. So essentially, the IRA must exclusively make the investment to benefit the IRA solely. Okay, it cannot benefit any other disqualified person. So whether it's a Roth IRA, a SEP IRA, a simple IRA, even a health savings account or a Coverdale, you can technically self-direct it, which means you can do any investment that is not life insurance, collectibles, or a prohibited transaction under 4975, whether it's equities or mutual funds or fixed income or real estate or cryptos or gold or hedge funds or hard money loans or private business investments. As long as it's not one of those 3 investment categories I previously mentioned, you can invest using your IRA or self-directed IRA, which is essentially the same. And you can do the self-directed IRA structure with any type of IRA, including an HSA or Coverdale. So Erica, thank you so much for that question. Second question on today's podcast is from LinkedIn, and it's a question again involving self-directed IRA basics. And here's the question. Why do I need to use a special self-directed IRA company and can't use Fidelity to buy real estate with my IRA? So this is a really, really good question. It's appropriate because I get this question 5 times a day. Adam, why do I need to pay you? Why can't I just go to Schwab or Fidelity and do this, or Bank of America or Merrill or UBS? Why do I need to do this for you? It's so stupid. I've watched your videos and you told me it's in the tax code. There's just 3 things I can't do. I can buy real estate. It's allowed. It's right on the IRS website. Why wouldn't they let me do it? And I have to explain, well, listen, an IRA custodian is not required to let you do every available investment. They can restrict you to do investments they feel comfortable with or they custody. Now, the traditional financial institutions feel more comfortable with traditional securities, equities, publicly traded products. That's their business model. That's how they make money. Whereas IRA Financial and other players in the self-directed IRA world, we're agnostic to the investment. We don't sell products. We don't sell investments. We do not provide investment advice. So it doesn't matter to us if you are buying real estate or gold or cryptos, and that's why we charge a flat fee. We're not involved in the actual investment directly from a fee standpoint, whereas the traditional financial institutions and banks are. So that's why they're going to restrict you and allow you to only buy the investments they sell. That's simple capitalism. Whereas the only thing we're going to limit to you as a self-directed IRA investor is what's limited by the tax code, which I mentioned in the previous question are life insurance collectibles and transactions involving disqualified persons under 4975. Otherwise, we don't care what you do. We, of course, want you to make money. But from a fee standpoint, we're charging you a flat fee either way. We're not charging you commissions. We're not giving you investment advice. We are simply helping you unlock your funds so you can do an alternative asset investment. So thank you from LinkedIn. Third and final question of today's podcast from Jasmine T. And Jasmine wants to know, can I roll my former employer 401k plan into a self-directed IRA? And the answer is yeah. When it comes to moving retirement money into a self-directed IRA, there's a couple rules to keep in mind. Any IRA, Roth IRA, SEP IRA, HSA, health savings account, or Coverdell, which is an educational plan, those can be rolled into an IRA or transferred into a self-directed IRA anytime tax-free. There's no other restrictions. As long as you're going custodian to custodian, bank to bank, you can do it as many times as you want, tax-free. Now, if you do it indirectly, meaning you take possession of those funds, you then have 60 days to roll it into a self-directed IRA, and you can do that once every 12 months tax-free. If you do it more than once every 12 months or hold it more than 60 days, you're going to generate a taxable event, potentially also a subject to a 10% early distribution penalty. In the 401k world, there are some additional rules to keep in mind. And those rules surround the topic of a triggering event, meaning in order to touch your 401k funds, you need to satisfy the triggering event rules. Now, essentially what the triggering event rules are in a nutshell are the following. 1, you leave your job. 2, you reach the age of 59 and a half. Thirdly, the plan closes. So in the case of this question, Jasmine, you have a former employer 401k. So that tells me you left employment. So now you've satisfied a triggering event because you are a former employee, meaning you have access to your former employer 401k funds. So thus you'd be able to roll those funds over tax-free into a self-directed IRA. Now, Jasmine, if you were still employed with your former employer and you were under the age of 59 and a half, you would not have access to those funds. You would not be able to roll those funds into a self-directed IRA. If you were over the age of 59 and a half, even if you continually be employed by that employer, you generally would have access to those funds and satisfy the triggering event rules and would be able to move those funds tax-free to a self-directed IRA plan. So rollovers are a huge part of funding self-directed IRAs. Approximately 500 billion or so funds are rolled over from a former employer plan each year. Obviously, lots and lots of people move around, change jobs. That's the beauty of America. You're free to move and work wherever you want. But just note, if you are currently employed and are under the age of 59 and a half, you can move your IRA funds anytime you want, but the actual current employer 401k funds, you would not be able to roll those to a 401k unless you reach the age of 59 and a half, or you decided to leave your job, or the company just terminated the plan or merged, for example. So that's it. Jasmine, thank you for that question. Thank you, individual from LinkedIn, and also Erica. Really good, really great questions. I hope you guys enjoyed today's podcast. This was an AdMail based off self-directed IRA basic questions. And I'm going to continue doing more of these. I get a lot of feedback saying, hey, sometimes you talk about these very advanced topics that are interesting, but like I need help on the basics. And before I can get to the advanced stuff, can you help with the basics? So I'm going to kind of try to do that more frequently. Let's just kind of go like 101, Wikipedia, basic concepts like deductions, tax credits, deferral, Roth versus IRA, profit sharing versus employee deferral. It's just basic concepts that I probably gloss over and don't focus enough on. And that's on me. That's my bad. So I appreciate all the feedback, and I promise I'm going to do a better job just kind of focusing more on the basic IRA terminology, or 401k terminology for that matter. So thanks again for hanging out with me today. I really appreciate it. Hope you guys enjoyed today's podcast. If you can always, if you wish, watch it on YouTube. Check out our great YouTube channel. But otherwise, just look forward to seeing everyone again next week. Ciao, and have a great day. Thanks.